I'm taking a look at a junior gold miner here, Novagold. This is one of my favorites, and I'm going to go over how to develop a framework for valuing fundamentally one of these junior miners. You can see this one's got some interesting price structure, so it's worth it to go in and get an understanding of what you'd be owning if you bought this. You see that volume trails off in the lows of these pullbacks. I mean, that's always interesting. Maybe this turns out to be another one, right? And you get another one of these, which would give us some kind of a little, you know, something like that, hopefully. So let's check it out. What do they own when you get this? This is a little $6 stock here, 6.25, not even. So by definition, this is a speculative issue. Let's check it out. What they own is this, the Donlin gold mine. You can see it is the ninth largest gold deposit in the world with 45 million ounces. It is a joint venture with Barrick. They're the big ones, okay? They're the second big dog after Newmont. And what do we have? The capability to produce 1 million ounces a year. That's up there. Let's see. So you've got 27 years of mine life. Okay, so that's your T, your time when we're figuring this out. So we've got 45 million ounces, a half ownership in that. So 22.5 million ounces. Let's see what we would do here. Okay, so we've got 45 million ounces of gold here divided by 2 because they have a 50% joint ownership. So they have 22.5 million ounces of gold that they could sell if this mine gets developed. Now let's call gold, let's be optimistic and give it a $2,000 price of gold. So if they sell all their gold, we're back up to what, $45 billion of potential cash flow in the future. So that's the sum total of what they're going to get. So let's see what the present value of that is. So let's divide it by our discount rate. Now, what do you want to give a discount rate to? I think generally we can give a 7%, so that would be 1.07%, and now you have to raise that to your T of 27 years. So raise it to the T, close your parentheses, and that's your denominator, 6.21. So your discount rate of 7% discounted over 27 years is going to be 6.22, 6.21. And your numerator was 45 billion. So let's see what that equals. So there you go. That is your market cap, your present value of that 45 billion of cash flows is 7 billion. Let's call it 7.25 billion. All right, close enough. So $7.25 billion. And then let's go and see what they've got as a shares outstanding. They've got, let's check it out. There. Okay, here you go. 333 million shares outstanding. Okay, so let's see. Now let's divide this 7.25 billion divided by 333,000. No, let's do million. Okay, equals, boom, there's your price, $21.75 for your price target of Novagold. Okay, let's see, dealing with Novagold. Okay, let's see, $6. You've got, look at this high, let's see, right back here, this high. Let's see what that high is. That corresponds to, look at the high, is 19.75 all the way back from November 2007. So, it looks like the market was trying to discount this all the way back in 2007. And so, even since then, look, they got their their request for developing. The DoD and all these guys had to sign off on it. Department of Minerals government agencies had to sign off on this in 2017 is where. So back here, I think it was must have been this volume. Look, and I mean, so since then it was a $4 stock. So you're only up 50% after they got that news. And I mean, that was iffy. You never knew what was going to happen there. But so that's a big deal that they've gotten that. So it's conceivable that you could get a move in this stock back up to 21 and 3/4. All right. Even that would be right about here. Okay. So that's what you're talking about is the current present value of this thing right now if they ever develop it, right? And look, that would make this look a whole lot more reasonable, wouldn't it? Wouldn't it just make this look more reasonable? Okay, so $21. Now, there's all kinds of things that could happen in between now and development because this thing is not producing any gold. But you can see here, this is how we would get a framework for developing a rough estimation of what a stock could be worth in the future, and that's if they pay you out all the money, the 45 billion in cash flows. They pay it out all to you and then they go on and do something else. And you know that's if they keep some of these as retained earnings and go blow it on some gallivanting around the world looking for the next great deposit, you know that's your money that they're going to blow on, which is highly likely. I mean, that's just the nature of these things. Is you're not getting all that 45 billion. They're not going to be paying that out in dividends. So but hey, maybe they're decent, and then they do find some other project that could be not as big as this, but they could do it too. They could do something, or I don't know, maybe they're nice and they pay you everything out, and this thing is worth 21 and $3/4. All right, so you'd be looking at, you know, about a 3x your money. So those don't come along every day. So that's why this is a speculative issue. Lots of risk. Most likely they're going to blow your money on some nonsense and this thing's just going to go straight down. But hey, there's a possibility that they do the right thing, maybe pay you out this thing in dividends over time, keep some of the retained earnings to get a joint venture with some of the big guys, and this thing edges its way towards 21. And who knows, maybe one day this could be like a Kirkland Lake. I doubt it, but you never know. And there you go. So thanks for watching Paul Power Merchants.